Chen Zhao is one of the world's most respected global market strategists with deep experience in macro cycles in China, emerging markets, and asset allocation. Now, at a time of war risk, oil volatility, dollar uncertainty, commodity swings, and fragile investor confidence, his value is the ability to connect geopolitics with portfolio decisions. For South African investors, let me tell you, the question is simple. Where is the risk? Where is the opportunity? And how should capital be positioned? So, Chen, a very warm welcome to you. I want to obviously look at two things stemming from the very insightful talk that you gave a little earlier today. One is oil and one is artificial intelligence. Let's start with oil. And I'm just wondering whether global investors are overly concerned right now, in your opinion, about the geopolitical risk around oil and the conflict risk. Where do you stand on that?
I think as investors, obviously I don't think they have a clue where oil prices are going to go. I think you can see that the market is just react to daily news. But I do feel that for a period of time, let's say last 2, 3, 4 weeks, the oil prices stop rising on bad news. That tells me that that actually the oil market is telling us something here. The oil market is basically telling us that the supply side, we're probably overly pessimistic on the supply side, especially when you think about the UAE leaving the OPEC. Why? The reason is pretty simple. They want to ramp up their spare capacity once the war is over in order to recoup their lost revenue. So there's lots of supplies going to come into the market. And once the strait was reopened, it will be reopened. I think it will be reopened because Trump is going to be, he's in desperate situation to get out of the war, regardless. And then there's lots of oil that actually trapped inside there, and then that's going to go back to the marketplace. The point here is this: there's a permanent, I'm pretty sure as a result of this oil surge, there has been a permanent destruction of oil demand. Just look at the EV sales, electrical vehicle sales across the world, just went through the roof. The reason for that is everybody want to move away from oil. As I said, once the demand destruction took place, it will not reverse. It will never reverse back. So I think the demand side destruction is for real, and supply side, actually, there's plenty of oil.
But Chen, for an emerging economy like South Africa, we are going to feel the impact of that spike for quite some time, particularly when it comes to inflation.
That's absolutely true. But here, South Africa has always has this inflation problem. But I'm talking about the sort of the U.S. economy. That is the dictating factor for a global bond market, for the dollar, for stock prices. But for the South African economy, of course, it's a bad shock because you need to import all this oil. And this is a country that has reasonably lower per capita GDP, and the ability to withstand the shock is much weaker. But despite of that, there's also positive things here going on here. Gold prices, real gold prices, is just really high right now. That should actually help you. Think about all this commodity prices. Lots of commodity prices that actually gone really good. That has something to do with South Africa too. So there's things that are helping, but there are things that are hurting. But I think net, I would say that probably 6 months out, positive is going to be outweighing the negatives. The reason for that is I think the oil prices are going to come down, way down.
Chen, let me push you a little bit on commodities, if I can. How do you think investors should be thinking about commodities right now? A cyclical trade, a geopolitical hedge, maybe a structural opportunity?
I think it's very much in the structural side. I showed the chart from 1900. That's 100-some years of chart pattern. Those are 4 cycles already, completed cycles. And we're halfway in up cycles. Historical regularity cannot be ignored. We're halfway in the up cycle. So it'd be like 5, 6 years to run in terms of commodity upswings. the question here is, what is it? It's not going to be oil. I don't think so, because Trump is going to try to really push down oil prices because for political reasons. For him, it's not economic reason. He can see the U.S. economy doing fine. It's a political problem because all his supporters are driving a car, and then the gasoline price is going up. That's a political problem. But for South Africa, you are such a big commodity producers. I think it's going to be hugely beneficiary going next couple of years. Think about the 2000s. It was a phenomenal time for South Africa. In the 2000s, after the tech bubble burst, we had a massive commodity boom. That was a beautiful time for South Africa, not only from the rand perspective, but also from the stock price point of view.
Let me ask you about the rand. It's often treated as a proxy, I think, for global risk appetite. Do you think it's cheap, fragile, or just reflecting the country's fundamentals right now?
I think it's both. I think if you think about rand, I would consider that as a proxy for real gold prices too. Whenever real gold prices are going up, rand is going up. So I think it cannot separate these two things because this is so commodity focused, economy. When commodity prices are doing well, especially gold prices doing well, the South African economy is doing well, and rand is getting stronger, and bond yields start to go lower because it was. It's a virtuous cycle because your bond yields actually was correlated with rand. When rand started to strengthen, your yield coming down, and stock prices going into a virtuous cycle. I think that's part of the story here. I'm bullish on commodities structurally. I think we're halfway through this structural bull market because of the reindustrialization drive in the high-income economy. Because of the desire in G7 to decouple from China, because they still think that is a strategic problem. So every country now is trying to invest heavily in their infrastructure and manufacturing. That by itself is going to be a very bullish factor for commodities, industrial metals in particular.
Where do you think China then fits into the global investment picture right now?
China has always been key competitors to the U.S. Ever since, I would say, 2010, 2015. That's when the economy actually grew substantially. And that was probably, in purchasing power parity basis, probably they are at a par right now. The key thing here is this. The last decades, I'm talking about decades of 2000s, and pretty much throughout the 2010s, the American and China's arrangement was more like, we call that sort of a Bretton Woods 2.0. What it was is that the Chinese currency was pegged to the dollar at a very undervalued level, so that the Chinese manufacturers sold a lot of cheap goods to the U.S. But at the same time, the Chinese economy is a high-income, a high-saving economy. They recycle the surplus back to the U.S. Right. So basically, that arrangement allowed the U.S. to have kept their interest rate and inflation low, prolong the consumption boom. But that model stopped working in 2008 or 2009 after the crisis because the Americans started to deleverage. When you deleverage, you stop consuming. So the Chinese export collapsed. Now, there's new systems start to emerge. What is this new system? The new system is that the Chinese are still very competitive in manufacturing goods. So they are no longer trading Chinese goods for American paper, but they are trading Chinese goods for ownership of resources.
Right.
That has something to do with your country.
Indeed.
Right?
Noticeably.
Yes. So they figured that out. I sold a lot of goods, but a whole bunch of American paper paid me nothing. Problematic. Now I'm sending a lot of goods to everyone, but I got a reserve I have to recycle. So where they recycle? They recycle to developing world, not only South Africa, but also in Latin America, they're trading goods for ownership of resources. That is very different from previous decade. The implication of that basically is you got to drive up commodity prices.
Let me finish with this. I said at the beginning oil. Let's finish with artificial intelligence. How close are we to that bubble bursting? You had some strong thoughts on that.
This year is what, 2026?
Yep.
So probably 3-4 years away. It's a historical pattern, right? So the bubble built during the decade and popped at the earlier days of the following decade.
Time for another bubble. Yep. Who gets hurt the most when it bursts?
Everybody. Anybody who investors are always getting hurt. There's like lots of bubble. Housing bubble. That was the consumers. Internet bubble. The investors. This time around, they're going to be investors.
Chen Zhao, thank you very much.
Pleasure.